Good morning, everybody, and welcome to our May 2021 Financial Reporting and Accounting webinar. As always, I have with me IFRS partner and audit partner in Perth, Ashley Woodley. Morning, Ashley.
Morning, Aletta. Good morning, everyone.
And I have my normal partner, Kevin Frobers, IFRS partner in Sydney. Hi, Kevin.
Hi Aletta, hi Ashley, and good morning to everybody out there. Welcome to this very chilly Sydney. I'm sure Melbourne and Perth are likewise.
All right, so we've got our normal presenters and you've got our contact details. However, before we start on this general accounting update, I wanted to put in some reminders around. We know that for every business decision that you make, there is a financial consequence. And often we talk about the consequence and how we reflect that in financial statements. However, we want to go a little bit further, and that is that BDO has also developed a business growth program, and enrollments are now open. Now, I'm involved in that and running it in Melbourne. In Brisbane, it's Tanya Titman, but there are also presenters across the country, Sydney, Cairns, Perth, etc. The strategic framework that we work for growth is we are looking at financial management aspects. We look at sales and marketing. We look at HR and we look at business operations. It is a 12-month program, so you meet once a month. And I think the nice thing is to meet like-minded people in similar situations and really build up that network and share ideas. So it's something that I'm really excited about rolling out in Melbourne. It's already been presented across the country. To give you an idea on the topics we cover over the 12-month journey, we look at some big picture planning, and I love the word big picture, and I love the idea that that's where we start. We do a deep dive into financial strategy, profit and cash flow, funding decisions, define your target market, a digital marketing strategy that's so important these days. We look at social media marketing, sales and lead management, building a great team, which is so critical to service and provide great services to great clients. We look at operational efficiencies, which you will hear about very soon today as well. We're looking at valuing your business, and we also, at the end of the 12 months, look at a recap and the results, and we look at how can we continue to collaborate going forward. So a very exciting program that I'm excited to be a part of, and the next series is starting in July. So please contact me or register on our website. However, today's agenda, this is usually our webinar that's really packed, because we are speaking to businesses about getting ready for 30 June reporting season. So we want to start today with, are you audit ready? And then we look at the transition to general purpose and all the other developments. So a lot of this is a quick recap of things we've covered in our webinar series over the last 12 to 18 months. Others are actually things that we've picked up while working with clients, discussions with other professionals. So we want to put a few things on your radar. Now you can see a lot of topics. We cannot go into these in depth, but what we're saying is please reach out to us. Happy to speak to you. So that's really what we're trying to achieve. Now, this webinar would be applicable for-profit and not-for-profit, but there are some not-for-profit specific issues that we should talk about. Portable long service leave, the new AASB 1058 and how that's been applied, etc. And therefore, I'm joining forces with Anthony White, our BDO not-for-profit leader, and we're doing a webinar on the 16th of June, and you can register on our website. So that would be a similar session to this, but really focus on not-for-profit aspects. So let's kick it off. It's a busy one. Are you ready, Kevin, Ashley? Everybody ready? Here we go. It's going to be a busy one. So first one is, are you audit ready? Now, I have asked and invited one of our partners in Brisbane to join us, Tom Hockburn, and Tom is going to talk about Are You Audit Ready? So Tom, thank you very much for joining all the IFRS nerds today, and please share your wisdom around Audit Ready with us.
Thanks, Aletta, and thanks, Ashley and Kevin, and thank you for everyone on the line. For some reason, I've had some camera issues today, so fortunately, you'll all just hear me talking. And look, Aletta's given me a really quick amount of time just to have a quick chat to you and more of a prompt for all of you on the line in terms of your readiness for your audits. I'm, as Aletta said, a partner in Brisbane, coming from our financial management consulting team, and we work a lot of the times with our clients in their audit readiness. So we're client side and support them get the best outcomes of their audit, and namely that's an efficient audit, a timely audit, a cost-effective audit, and you know, minimising the levels of stress at what is a very busy time of the year. So what I just thought I'd put to you, and as you can see on the screen, is just a very high level, very basic checklist that will be or has been provided to all of you in the handouts for today, that I'm suggesting that you could look through and act as a bit of a prompt as you move into 30 June year end or any other year ends that you're working towards, just to help you in your planning as you move through that process. Obviously, a key to the audit readiness is your knowledge of the accounting standards. You'll see that I'm not referencing any of that here because Aletta and the team is all over that, and we'll talk to that in some detail today and throughout some of the other sessions. So I've specifically not gone into that, but that is something that's key. So just running across the top for all of you, I've provided 5 categories there. That I'll just skim across the top really quickly. So first of all, for those entering into a first-time audit, and this might be first-time audit for an organisation, or if you're new to an organisation that has already had audits and you're really getting familiar with the organisation, just some key things to think about there and making sure that we're aware of in advance of going to that audit, across the audit engagement, the type of financial statements, and I know Aletta will talk to some of this as well, so I won't talk to that too much as well. Particularly if we're first-time audits, do we have prior years? Do we have a different period than 12 months? So those are all the sorts of things to think about in your first-time audits. Also, obviously, you need to think about your records management and the availability and completeness of some of the key information that the auditors are going to need. That's not only transactional information, that will include your budgets, your forecasts, your management reports, board reports, some key decision making if required, or if some things have happened throughout the year that will support the audit process. The systems, procedures and controls, and I recognise we're at a time of year where there's probably not a lot that you can do now that's going to change your audit from a substantive testing to a controls based, but that's certainly something that you can be looking at and continually improving to improve the approach and how the auditors audit your group. So there's just a few triggers there to think about and act on where you can. And then obviously we're preparing for the auditor. So for those of us that have or have had our interims and as we're working towards our final audit, have we got a plan and a timing for the preparation and completion of all of these key artifacts and deliverables for the auditors? Obviously there's some key accounting position papers that we will always need to prepare. If we need any valuations, obviously planning those early is very critical as well. And getting the auditor feedback early, because they're obviously in a busy time of year as well, and if you don't get them early, sometimes it can stretch the time frames. The last one that I just wanted to touch on, and I'm very mindful of the short amount of time I've got, is the team readiness, and often this goes overlooked because it is a challenge. Just how prepared are the team for the audit and for the preparation of the financial statements, and particularly if there's any key people or single points of failure in the people, and how do you mitigate and manage that better. We've experienced a number of situations where those key people leave at inopportune times, and that leaves the organisation somewhat vulnerable to having to bring in contractors to just get through the audit, and that's obviously a more expensive outcome. So really thinking about that and planning for a bit of a robust team so that it can manage ins and outs of people. So look, mindful of my time, that's all I wanted to touch on. This has been provided to you, or will be provided to you. So recommend you have a look at this, use it as a prompt for you moving forward. And I believe my contacts have also been provided as well. So feel free to reach out and have a conversation with me with any questions. I'm always happy to have a call and a conversation. Thanks, Aletta. I think we've just got a short poll that we'll turn to, and then I'll hand back to you.
Yes, so thank you very much. I've shared a poll based on what Tom has so beautifully explained. Let's just assess, you know, your audit readiness. Are you well prepared? Your audit runs like clockwork year in and year out, or we regularly have one or two issues that we have to manage, or there always tends to be audit, you know, audit management issues or management points to address after the audit, or it's not great, you know. The audit seems to be a little bit of a fight each year, a prize fight. So what's your experience? It will give us a little bit of an idea around audit readiness of all our participants. It would be wonderful if you could, you know, participate and share your views. Thank you to those people who've already participated. We've already have just over 50% of people have voted, which is amazing. I'll share the results very soon. Let's see if we can push it up a little bit higher. Let's see if people can, you know, maybe think and reflect on what they think. The view
It's kind of interesting, Aletta, while you're talking. I'm having a phase back to my audit days, and basically all four of those were always ticked every time I did an audit. So maybe my multiple personalities ran with all four during any audit season.
Yeah, that's true. I suppose it could change from year to year, Kevin, and maybe it could change from
week
role
to week.
role. Yeah, hour to hour, Kevin. Will we go that far?
Probably.
All right, so fantastic. So we've got around 70% of people have already voted. Thank you very much for sharing your views with all of us. I'm going to close that and I'm going to share so we can see what people have thought. And this is always fascinating to look at. There's a little bit of a delay there. You see 33% well prepared. I want to say well done. Great job. That's fantastic. As an auditing firm, we're very proud to hear about that. And I'll let our auditors know that you are ready. You know, 51% said we regularly have one or two issues. I suppose over the last few years, it could have been revenue recognition. It could have been leases. Hopefully we can you know, address those before the auditors arrive. 12% says, you know, there could be some audit management letter points to address, and only 4% not great. And I think that's fantastic, because that actually means you've got a really good working relationship with your auditor, and that's a very important relationship. Tom, surprised by the findings? Any final comments?
No, I think that's a really, really positive outcome. Over, you know, close to 85% of the group are, you know, probably have a pretty smooth audit, and it's probably for that 16% that, you know, have a few more issues. Probably just looking at having conversations with the auditor in advance to try and improve the audit year to year, and often that comes from, you know, addressing some of those audit management points early after the audit's been completed, so that they don't come up again next year and having to deal with you know, unaddressed points. So no, that looks pretty good. Thanks, Aletta. Thank you, everybody.
Thank you very much, Tom. Great to have you here. I just wanted to also flag that although Tom is in Brisbane, he looks after financial management consulting also nationally. But if you want to reach out and you need help to be audit ready in Melbourne, you could obviously contact me. You can contact Ashley in Perth, Lynn in Adelaide, or Andres or Kevin in Sydney to help you. At the moment, our Melbourne team is actually really busy helping a number of clients to get audit ready, either helping with preparing financials, reviewing disclosures, maybe the new AASB 1060. And I also have some of my team members helping audit clients of other firms to get ready around lease accounting. As you know, it's an ongoing saga, so please reach out and we would love to help you. So if we move on to transitioning from special purpose to general purpose financial statements, as you know, the current state, we've got a decision to make whether the entity is a reporting entity or not. If the entity is a reporting entity, prepare general purpose, which depending on whether they've got public accountability or not, could be tier 1 or tier 2. And that tier 2 at the moment is reduced disclosure requirements, so the grayed out paragraphs in the standard. The right-hand side of this graph is actually the problematic one, and that's where an entity is not a reporting entity under SAC 1 and therefore can prepare special purpose financial statements. And, a world of pain, what exactly do we have to comply with? Do we have to lodge consolidated financials with ASIC and the ACNC? Which accounting standards to comply with? And we know there's a lot of uncertainty currently. Now, definitely our BDO view would be if you're lodging financial statements with ASIC, it's to comply with all the recognition and measurement requirements of all the accounting standards. But I know, there has been some diversity for a long time in practice. Therefore, the AASB issued AASB 1054 and say, please disclose the extent of which you're complying with the recognition and measurement requirements of the accounting standards. At least make it clear, crystal clear, in note 1, exactly which standards you're complying with and which not. Make it clear whether you're preparing consolidated financial statements or not. And this is also to get ready for the future, because we all know we're on a pathway to general purpose financials, but current state, you can still potentially argue that you're not a reporting entity. You can still potentially this year argue I can prepare special purpose financials, but then make it crystal clear which accounting standards you're complying with and which not. So that's the current state. However, the future state from 1 July 2021, so that would be 30 June next year, and remember we need comparative information. The future state, we know that we are removing the reporting entity concept in Australia. SAC 1 has been withdrawn, especially I'm talking for-profits. Not-for-profits is on a longer time frame, a longer journey. But we know that now we'll have to look at whether we're required to prepare financial statements in accordance with Australian accounting standards or not. And there's actually 2 different buckets. On the left-hand side, the yellow one, if legislation requires you to prepare financial statements in accordance with Australian accounting standards or just accounting standards, that would mean you have to prepare general purpose financial statements. So from next year, 30 June 2022, if you have to prepare and lodge financials with ASIC as a result of the Corps Act 2001, it will have to be general purpose financial statements, which will be consolidated, etc. If you're preparing financials, not as a result of the Corps Act, but it's in your constitution, it's in a trust deed, etc., and that document refers to Australian accounting standards, very important, Australian accounting standards, and that document has been amended for any reason on or after 1 July 2021, you would have to prepare general purpose financial statements. Therefore, If your constitution currently says you have to prepare financial statements in compliance with Australian accounting standards, you're okay. You can continue to do special purpose financials even next year. However, as soon as you touch that constitution or that trust deed for any reason, right, you will be caught, and then you have the opportunity to remove Australian accounting standards and replace it with something else. And therefore, as soon as you amend it, you're caught, and then you'll have to prepare financial statements that are general purpose financial statements. So please be careful. So it's important to know about this. In future, if you are preparing general purpose financial statements for the reasons explained on the previous slide, AASB 1053 is still appropriate, and it says you're doing general purpose. Now you have to consider whether you have public accountability. If you have public accountability, you are tier 1, which is full IFRS, full disclosures. If you are in tier 2, because you don't have public accountability, going forward from next year, you will do simplified disclosures under AASB 1060. So currently, if you're in tier 2, you would do reduced disclosure requirements. However, from the end of next financial year, 30 June 2022, tier 2 is going to simplify disclosures. So again, if you're going from special purpose to general purpose this financial year, 30 June 2021, if you're going early, the best advice I can give is, and if you're tier 2, is go for AASB 1060 right from the start. I mean, why bother with RDR if you anyway have to change in 12 months' time again? That would be double work. I think what's really important, and we've had a number of webinars on this already, is how do we transition from special purpose to general purpose financial statements? Now, we've discussed it at length, but I wanted to put this diagram in because there's considerations. You have to think, you know, if I'm a for-profit and I have to prepare general purpose financial statements, that first layer is on the left-hand side in blue. If you now have to prepare separate financial statements, meaning you have to prepare parent entity financial aid statements. You don't have to consolidate because you don't have subsidiaries or entities you control. If that's where you're going, you have to consider, what have I done in the past? If I've applied all the recognition and measurement in the past, really there's no transition adjustments because you've been doing the right thing. There's some new disclosures though. That's the big red block. However, if you previously did not apply all the recognition and measurement, now you have to transition, and you can either apply IFRS 1 or IAS 8. And there's a number of decisions and consideration which is the best path. Please speak to us about that. Again, new disclosures. Now, the yellow part of this diagram is where it gets really complex, because going forward, you've assessed you have to prepare general purpose financial statements that are consolidated financial statements. And now we've got 3 different places that you could have been in the past, right? That would influence your transition journey. Right in the middle, you could previously have applied all recognition and measurement, and you could have done consolidated financials. Again, you're not really moving, you know, you've already done it perfect. It's just new disclosures. Or the middle one in the yellow block, previously you did not do all the recognition, but you at least did consolidated financial statements. So you have to transition because you now have to do consolidation. So IFRS 1 or IAS 8. And then if you previously did not prepare consolidated financial statements, that is a beast of a different nature. Again, how do we do that? How do we do that using IFRS 1 or IAS 8? So there's a lot of considerations, a lot of different paths. IFRS 1 we used when the large end of town transitioned to IFRSs in 2005. We have to dust off that standard and now apply it again if we go from special purpose to general purpose. And we are rolling out quite a bit of training on it. In this diagram, I just wanted to flag that for 30 June this year and 31 December this year, if that's your year end, you can still do special purpose if you're not a reporting entity. However, there are some benefits to transition early. You get some transitional relief. So I think it's a good idea to consider that transition early. If not, please know that from 1 July we have to capture the appropriate information. So next year, mandatorily, it's general purpose financials. You really have to consider what does the future look like for your organization. I've also included a slide on how do we select whether it's IFRS 1 or IAS 8, going from special purpose to general purpose. I'm not going to talk through it. We've discussed it in previous webinars, but it's a reminder of key considerations. It's not an easy decision always. Now, from a BDO perspective, we've come up with our 5 steps to successful transition from special purpose to general purpose. Obviously, first of all, you have to assess whether you do have to prepare general purpose financials in future or not. I think the second thing is to do a health check. A lot of people are telling us we've done recognition and measurement in the past, but when we have a look, we realize they've missed a number of things. So step 2, that health check is critically important. Then we do a gaps analysis around systems, processes, knowledge, maybe get Tom and his team involved to make sure you put the right processes in place from a financial management consulting perspective. We also have, select the appropriate transitional method, and then we get to doing the work. We implement it and we prepare disclosures right at the end, AASB 1060. So you cannot jump into step 5, just do disclosures under AASB 1060. You actually have to go through a whole process. Now, as part of... Yes.
Sorry, can I jump in? And it's partly because I know that we've given Aletta the bulk of the work up front, and so she needs to get some water into her mouth and also just take a breather. But partly driven by the fact that I just want to just kind of draw out the first step. We are very happy to have a short conversation with anybody who's on today's webinar at step 1 before you jump into this, because as Aletta was talking, I made a note of all the decisions in the first step. And it's first of all, AASB 1061, are you going simplified? It's, are you trying to get on an IFRS 1 or an IAS 8 transition from special purpose to general purpose? Do you go early or do you wait till the mandatory year? There's a consolidation question in there. And actually also audit readiness, which is where Tom came in this morning, because if you're going to be audited for the first time, sometimes the mental health of your staff, so that was one of Tom's things, for example, team readiness, they're all important considerations in step 1. I'm probably having about 3 conversations a week with clients and even potential clients on the first step, and I think it's probably it's no small feat to actually say a 30-minute conversation or even an email about what are my problems and what are my options at step 1. Is more than happy to have that with you if you want to talk about it, because Aletta is right, don't jump to step 5 or don't jump to step 3. That is really the important part of this. And like I say, a lot of organizations are realizing that this is actually the way to go. I think for this audit readiness 30 June 2020, probably the key question for a lot of organizations is, where are you coming from? So your starting point is all different. But the 2 that keep coming up is, I want to do simplified disclosures this year, and so they're trying to jump to step 5 really quickly and they're missing all the others. But then the other one is actually the guys who are going from special purpose to general purpose. A number of organizations are trying to do that this year. That's fine, but it is now the middle of May, and if you're just starting to think about that, you want to start really thinking quickly about that, because time is running out, and that's when the audit readiness becomes a problem and all those types of things. So just putting it out there, we're all more than happy to have a little conversation on step 1 to try and talk through your options, because it may be the biggest investment you've done, and it might just help you down the track.
Thank you, Kevin. Absolutely agree. And then the other thing we've done is we've rolled out a 20-week IFRS training blitz. We're in week 5 already, virtual workshops where we're looking at big picture of 20 key accounting standards. these virtual workshops are 2 hours, practical case studies, question book, answer book, slides, high level overview. Do you know what the requirements are of all these standards? You can register for all of them, or you can register for those you're interested in. If you've missed some of them, the recordings are available, so you can reach out to me, no problem. AASB 1060 simplified disclosures, a lot of people, as Kevin said, jumps directly to AASB 1060. Now, that would be appropriate if you're currently general purpose tier 2 doing RDR and you just want to go from RDR to 1060, no problem. However, if you're currently doing special purpose and you have to go to general purpose and then the disclosures are AASB 1060, then you can't just jump to step 5. There's a process to go through. So, going forward, if you're in tier 1, you do all the accounting standards. Tier 2, RDR would be withdrawn from next year. So you'll go AASB 1060. If you prepare special purpose, and in future, if you're still doing special purpose, there are certain minimum disclosures applicable. I've put in some slides around the background to the standard, the effective date, 1 July this year, how it was developed. If you're interested, it's based on the disclosures in the IFRS for SMEs, a lot of new disclosures around related parties, because that's a big risk. And then finally, from a BDO perspective, we have a BDO disclosures management tool where you can work through this tool to tailor all of those disclosures down to the disclosures actually appropriate for your organization. You can then give the auditor access to that checklist. It's electronic in the cloud, and the auditor can see how you've answered the scoping questions. The auditor can see why certain disclosures you haven't included because maybe it's not material. And it's a nice working document between you and the auditor to get to compliance with AASB 1060. So again, please reach out if you want to look at that a bit more. So if we move on to what are the new accounting standards and interpretations for this reporting season. Now, I would say the only genuine new one would be amendments to IFRS 3 around the new definition of a business. And this was our January webinar this year. And we've stepped through the 5 amendments that was made to IFRS 3, adjustments to the definition of outputs and business, clarification around input and substantive process, and then also the addition of an optional concentration test. So our January webinar looked at this in detail. Now, we know there's been a lot of activity over the last 6 to 9 months around potential business combinations. The biggest risk is actually to assess whether you've got a business combination or not, and therefore really important to consider the new requirements in IFRS 3. I think one of the key things we've got is that a business going forward, if you do the normal assessment, a business needs a minimum of an input and a substantive process. So an input, a substantive process that significantly contribute to the ability to create outputs would be a business. And there's discussions on what is an input, discussions and guidance, extensive guidance around what would be a substantive process. And then discussion around contribute to outputs. So outputs are not necessarily required, but it could contribute to the ability to create outputs. It's not necessarily that there's already outputs. And that would give you a business. So another good webinar to revisit. I think the key thing, however, is that we've got an optional concentration test. Now, this is important. This optional concentration test could potentially help you to make an assessment that you do not have a business combination, right? However, if you do this optional concentration test, it's important to consider that if we say, hang on, I cannot do the optional concentration test and quickly assess that it's definitely not a business combination, then it doesn't mean that you definitely have a business combination, right? Then you are thrown back to the full assessment. And then you have to go through the whole input substantive process, etc. So it could be a shortcut if you've got a gut feel that this is not a business combination. However, it's not a shortcut to conclude that you have a business combination. So it's this, in this diagram, we try and explain all of that and how it links together, and when you would potentially use it. The other thing that's important to note, you could potentially say, if I do this optional concentration test, I get to an asset acquisition. However, if I go through the whole assessment, I could get to a business combination. And now, because this concentration test that get me to asset acquisition is optional, I could decide to ignore that and go with my full assessment that gives me a business combination. So there's an opportunity here to consider the alternatives. So really important to have a look at that. And again, this is complex, it's new, it's difficult. Please speak to us if you need assistance, and please do it before the auditors arrive. In the next area, we've included a section on ASIC, our regulator focus areas and frequently asked questions. And really, these are very similar to what we had last year, so I'm going to run through them fairly rapidly. So as you know, we're now already 2 years into the new regime around reporting thresholds. So this was part of the journey to get ready for transition to general purpose financial statements. So I just want to put a reminder in there. Then very recently, I think last week or 2 weeks ago, ASIC have issued a media release where they've given us an extension of our reporting deadlines. I think the key thing here is there's no extension for foreign registered companies because they do not fall into Chapter 2M or Chapter 7 of the Corps Act. And I know last year there was a little bit of uncertainty around that. So please note that second bullet point, foreign registered companies, no extension to the deadline, to the reporting deadline. So I've included a link to that media release. I know a lot of organizations last year during COVID actually continued to meet reporting deadlines. But you know, if you need this due to pressure, staff resourcing, difficulty working from home, it is a possibility. The other thing that ASIC has done very recently, and this will be included in our May newsletter, is that they've amended the financial requirements for some types of AFS licensees, so that they will be able to count right of use leased assets towards determining their net asset value, their adjusted surplus liquid funds and surplus liquid funds. So this is a big I would say win. We've been discussing, and many entities have been discussing this with ASIC for a long time. Fantastic that this has come through in time for 30 June reporting. Again, I've put a link to the media release there for you. The other thing, finally, from an ASIC perspective, is ASIC last year issued frequently asked questions. They called it COVID-19 implications for financial reporting and audit, frequently asked questions. There's, I think, 22 when I looked this morning. They address financial reports and directors' reports, solvency statements, reporting deadlines and AGMs. It looks at other audit-related matters. It looks at changes in ASIC activities. Again, they do update and release additional FAQs from time to time. There was a very important one, I think it was FAQ 9 around lessor accounting under COVID. So, you know, it's good to have a look at these FAQs and to have an awareness on what our regulator is looking for. So I thought I'll flag that. No big change from last year. but at least I think it's good to have a look at that, and that's why I've included that. The next one that I want to talk about is revenue recognition. Now, you might say, Aleda, you've missed the boat. IFRS 15 has been in for 2 years. What are you on about? And I can tell you that we are getting regular requests from clients that are still grappling with the implementation of IFRS 15. And it's really, they've done it correctly when they transitioned. But as entities are entering into new, different types of customer arrangements, what would be the appropriate revenue recognition? A lot of businesses have changed their business model over the last 12 months, the way they contract with customers, and therefore there's implications for IFRS 15. So this is something that you continue to have to look through the 5 steps. And BDO have a beautiful publication on IFRS 15 on our website. However, I think the bigger issue is that, again, IFRS 15 has significant requirements around modification of contracts with customers. And I've included in the next 2 slides an extract from our BDO publication on IFRS 15, which says, if you modify a contract with a customer, what would be the outcome of that? And it's, it's complicated. So on this first slide, I've said, a vendor accounts for a contract modification as a separate contract to the original one, such that the accounting for the original contract remains unchanged only in the following situations, and both of them have to be in place. So the scope of the contract changes to the addition of additional promised goods and services that are distinct. And the second thing that has to be in place is the price of the contract increases by amount of consideration that reflects the standalone selling price. So if you're adding a performance obligation at a fair market value, you can treat it as a separate contract. Now, please don't get confused here. Legally, it might be in the same contract, or legally, it might be in different contracts. Remember, we don't care about legal form here. We are saying the substance of the arrangement. If it's 2 legal contracts, is the substance that it's actually a modification? And if it is a modification, if these 2 things are met, even though in substance it's a modification, should we, to simplify the accounting, actually treat it separately? All right, so first you bring it together in substance, and then because it's adding a performance obligation at fair value, you then keep it apart. But that's an assessment that you have to go through. And actually, in my experience, it's quite rare that that happens. Because when we start to modify contracts with customers, it's not just I'm adding something at a fair value. You can add something, but you get a discount because you're already a customer. Or maybe you're reducing something during COVID. Initially, I wanted a fancy barbecue area, and now I'm, a barbecue area and a spa, and now I just want the barbecue area or whatever. So, it's not usually adding something plus paying fair value. So in this diagram, we said, if you've gone through the assessment on the previous slide, and it's a contract modification and not meeting those 2 criteria, now we've got other decisions to make, Are the remaining goods and services to be transferred under the original contract distinct? If it's yes, then there's a termination. If not, is there maybe only one single performance obligation? If you say yes, then it's actually just a continuation. And if the answer is no, then it's mixed. So you've got a bit of a mix between the 2 approaches, termination and continuation. Now, this is a particular difficult aspect of IFRS 15. So if you are starting to change contracts with customers, or even entering into new contracts with existing customers that potentially in substance is a modification, please reach out so we can help you. A beautiful publication on our website that can also help you. I'll take a sip of water before I look at my favorite standard, lease accounting.
While Aletta's looking at that, I'm just saying to you, we've got some interesting topics coming up down the track. So stay tuned just a little bit over 12, because we will be finished in a short period of time after that.
Yeah, listen, we're going as fast as we can. I think we're more or less at the halfway mark. These are all reminders and saying, speak to us if you need more. We can refer you to publications. We can refer you to webinars. Now, lease accounting, at the moment, I'm actually working with 2 large organizations that have thousands of leases around lease accounting. Initially, they thought they could do it themselves, maybe even in Excel, but you know, the lease accounting pain is very real, and it becomes particularly a pain in future when you do changes. So please remember, we have a software solution that is absolutely state of the art, BDO LEADE SaaS. We can also outsource to our very competent and friendly team. And you know, I would say even clients with less than 10 leases are outsourcing because Excel is becoming burdensome. You know, the ongoing management is the issue, and there's a lot of trips and tricks and traps. I'm not going to talk through all of them. The biggest one is determining lease term. And all I'm going to say here is, please do not think your legal lease term is lease term for accounting purposes under AASB 16, because that's absolutely incorrect. A month-to-month lease that you could argue has a legal lease term of 30 days, and therefore you say it's a short-term lease, could potentially have a lease term of 20 years. When we're finished with it, when we've looked at substance, when we've looked at economic penalties. Now, we've talked about this many times, but lease term is critical. You have to get this right. Now, this diagram is still one of the ones I'm most proud of in my life, because it really cuts into the heart of the ongoing management of AASB 16 around reassessments, modifications, terminations. When do we expect just an adjustment to the liability and the asset that's the same? When do we expect a P&L impact? When do you have to adjust your discount rate? So this is pure gold. The other one is COVID-19 related rent concessions. You know, there's been a recent change to criteria 3 on the slide. Just last month, the IASB said criteria 3, if you get a reduction in your lease payment that affect payments originally due on and before 30 June 2022, not just 30 June 2021, you can still apply this practical expedient. So that date in criteria 3 has been changed, and it's been changed, and we've explained it in this publication. Now, there are some issues here. It will apply retrospectively. So maybe last year you thought you didn't meet the practical expedient, but with this change, you now do meet it. How do you account for that? Worked examples in this beautiful publication. Kevin, I can't wait for you to talk about impairment testing, because I've now I really need a lot of water, Kevin. But what I want to say about lease accounting, this is pain on steroids. If you need help, please speak up. Contact us. We're happy to help you. We've got the most amazing tool. And I've looked at many tools. This is an amazing tool. It is absolutely compliant with IFRS 16, so we can do it for you. Please reach out. Kevin, impairment testing, your favorite topic.
It is I get so excited. Aletta sent me some message last night saying, are you doing the impairment section? And I was like, Aletta, how can you even ask that question? It's like, of course I'm doing the impairment section. And I will just say to Aletta, well done on that. There was a long slog. And maybe we should have put the order a bit differently to give you a break, but you did amazing, Aletta, so well done on that. I will say on the lease accounting and the revenue, I'm also starting to see those revenue modification queries come through. But the lease accounting, it is amazing how many Excel attempts last year have now become BDO lease management requests this year, because the complexity of the ongoing management is starting to creep through. So just get on top of that. If you haven't looked at your lease accounting for a year since last year, maybe that's one of those audit readiness things you just want to think about, because sooner rather than later, it's probably a good idea. Now, impairment testing. This is really an interesting one, because last year when COVID hit, we were all over the place on what was impairment and are there going to be write-downs and all that type of thing. And that's all still true. The question is, where are we? We've had this rebound now from COVID and all this money is sloshing around in the system. And so the question now is, well, you know, do we now start to write things back? Is everything okay? And so all the questions are still valid. It's just we're a little bit on the other side of, shall we call it, the curve. And that's going to become sort of the big question. ASIC have still got this on their list of focus areas. I think it's been there for probably about 3 years, maybe even 30 years. It's always been a focus area of ASIC. But the big question here is, are we doing fair value or value in use, the higher of, when we're doing measuring recoverable amount? And the big ones, of course, are your non-current assets, right of use assets, goodwill, intangible assets, and so forth. Most organizations sit with the 5-year DCF, doing a value in use, but of course fair value if that's higher. And I think that's really just the high level focus area. Now, the timing of the impairment test, I guess if you haven't done your annual test on goodwill, then it probably is going to be done at 30 June. And the big thing with impairment this year is, other than the goodwill and let's say the indefinite intangible assets, you need to do an impairment test. You have indicators, and there are indicators all over the place. It might be true that there's money sloshing around in the system, government's putting stimulus into the system. I heard somebody say the other day, the fact that there's money in the system from government because of stimulus is an indicator all by itself, because they're throwing money to stimulate the economy. So there's an indicator. So it's a really interesting assessment. You want to get on top of this one really quickly. Do you have an indicator of impairment on your assets, any of your non-current assets that need testing? And if yes, you need to do the impairment test. The important thing here is we're starting to find out that how you go about the impairment test is problematic, and especially if you're valuing things like software, or you're valuing things like customer lists, which are already on your balance sheet, but you need to do an impairment test because that asset has an individual impairment indicator. The question is, do you actually need an external valuer to be involved, or any type of valuation? So you want to get on top of that really quickly, because you don't want to be running around appointing valuers sort of in August next year, whenever your deadline starts to approach, because this is not only about goodwill, it's also about individual assets like software, customer lists, and so forth. I'll jump right past that one, Aletta. I just want to remind you that we have on the next slide an impact of COVID-19 publication, which you can click on the download and have a look. Now, this was actually issued last year at the height of COVID-19, but that doesn't mean the points are not relevant. They're actually all still relevant. It's just we're in a different place in the cycle. And the big thing here is how you apply your 5-year DCF. That's where most organizations are going to be once they have the indicators of impairment. But as I've mentioned, we've got a couple of ones there, and like I've said, there's a new one that to add to the list, a conceptual argument that says if government's still stimulating the economy, isn't that an indicator of impairment all by itself? Well, I think the reasoning behind that is, well, actually they're stimulating the economy because, let's face it, we're still in the height of a global pandemic, and what's the impact of that? Now, I'm going to jump a couple of slides in the interest of time to the areas of concern, which is really my last bit on this. This is really the biggest area of concern I have for 30 June 2020. Last year, we were all talking about, are we going to have a V curve, a W curve, or a U curve? If you don't know what I'm talking about, that happy to take a query from you. It's really a valuation question, but it's really just, we had a downturn, how are we going to spring back? And already we are getting goodwill impairment tests, which are sort of forecasting a V curve because there's been this snap back. That may be true in terms of the effects of JobKeeper and so forth. But I'd just like to remind everybody that the second quarter results are not yet out. The impact of JobKeeper sort of phasing out has not yet been really forecast into the economy. But here's the real thing. It is obvious we don't know when we're going to open the borders in Australia again. And the borders are still shut. And I think after the budget, there was a bit of floundering a little bit from both the Treasurer as well as the Prime Minister about when that might be. The point I'm trying to make is that I'm not so sure a V curve is locked in. It may be a U curve and it might even be a W curve. I have started to hear some economists, although I think it's probably the minority, and I'm not an economist, I should just make that clear. I'm not an economist, an IFRS advisory partner, but I have started to hear some of the valuation experts and some of the economists talk about a W curve. And what that means is you've got a bit of a snap back, but then what happens is it peters off again because maybe things aren't quite as locked in as we thought. And that W curve is going to happen in the forecast year in your DCF impairment calculations. It's going to be in year 1 of your future looking forecast. So if there's a W curve to come, now's the time to forecast it into your budgets, which means it's going to flow into your impairment test, and it's going to flow into your going concern, which is the next session we're going to talk about. So I just want to put that on. That's the thing, the biggest area of concern. There were a couple other points in there, but nothing. Everything pales in comparison to the shape of the curve, I think, on the impairment test. Now, I'm going to leave impairment test. There's a link you can follow to our guide there. But just a bit of a sneaky BD opportunity, Aletta. Next month's webinar will actually focus on forecasting cash flows into impairment and goodwill models. And so I'm going to leave impairment because we'll circle back next month on that. With that, back to going concern.
Great, thanks, Kevin. So yes, my topic today is going concern, and I must admit, over the last 2 reporting seasons in particular, we've been involved in a lot of discussions around going concern, and unfortunately, they always seem to be quite late in the piece. So this is following on from Tom's audit readiness presentation earlier. This is one of the key areas where you should be having early discussions with your boards and auditors so that there's no surprises at the end. All right, so for going concern, as everyone would be aware, the accounting standards require that an entity's financial statements be prepared on a going concern basis, unless, of course, the entity is to be liquidated. So this requires management to make an assessment of the entity's ability to continue as a going concern. And in this current economic environment, determining the appropriateness of this requires a greater degree of judgment than usual, including, as Kevin mentioned before, thinking about what will the impact be when JobKeeper is phased out and other government stimulus measures come to an end. How will that impact your going concern assessment? So looking at this decision tree, I'll just quickly walk you through management's obligations in relation to going concern and then the related disclosures following from those decisions. So firstly, if we have a scenario where there are no significant doubts about the entity's ability to continue as a going concern, we end up in the green box, which shows you that there's no specific disclosure requirements that you need in relation to going concern. However, there is guidance and BDO view that it's probably best practice to still disclose the effects of COVID-19. And then at the other end of the spectrum, where management have concluded that the entity is not a going concern, so you end up in the red box on the far left. So the financial statements are prepared on an alternative basis, and disclosures required to explain this fact as well as the reasons why the entity is not regarded as a going concern. So those 2 scenarios are fairly obvious, and then it's the scenarios in between that require the most judgment and where additional disclosures required. So if we have a situation where there's significant doubts about the ability to continue as a going concern, however, management conclude that there's no material uncertainties because there's particular mitigating factors in place, then you could end up back in the green box. But most likely, you would move down the decision tree and into the blue box, as it's most likely the conclusion would involve significant judgment. So in this scenario, the disclosure requirements of IAS 1 paragraph 122 will be applicable, and you're required to disclose what the close call situation was and what the mitigating factors are and the judgments that have been applied to conclude that there's no material uncertainty. And then the final scenario to consider for going concern is where management have concluded that the going concern assumption is still appropriate. However, there are material uncertainties. And in this case, we end up in the yellow box, and the entity is required to disclose what these uncertainties are, as well as management's plans to mitigate the uncertainties, and then also what would be the outcome if those plans don't eventuate. So as you can imagine, the accounting standard setting bodies globally are paying close attention to the requirements around the assessment of the appropriateness of going concern, and to further support the consistent application of IAS 1. The IFRS Foundation has published this educational document with the link we've included on the slide to assist with your going concern assessment and the types of disclosures that they are expecting in pretty much all entities given the current global climate. So they were the main points I wanted to touch on for going concern. I think I have to pass back to Aletta, even though you've done so much already, onto share-based payments.
Thank you very much, Ashley and Kevin. I thought I'll just add one thing maybe on impairment, and that is a number of clients have started to say, can we reverse impairment losses that we booked last year? You know, the economy has recovered so well in Australia. And I must be honest, I'm quite hesitant to start to reverse impairment losses because although the Australian economy has recovered, it is as a result often about jobs, government stimulus. We know there's still issues around borders. We know the vaccine rollout is slow. We know there are third waves in many other countries. So I think that is something to be very careful of. We cannot say we're out of this, it's over, and just reverse impairment losses. That's maybe just a final point on impairment. And I think going concern, you know, continues to be an issue, especially now that JobKeeper has run out. So, you know, definitely I would say actually a higher emphasis on going concern this year than last year. Because last year government really did a lot to keep organizations going. So two very important areas. Thank you, Kevin and Ashley. The next one that I thought you know, these are based on things that we're seeing, questions we've been asked, and it's around share-based payments, and in particular, changing expectations. Organizations, I think all of you would know, we've got skills shortage, staff shortage across Australia in so many industries. You know, we don't have international students, we don't have international secondees. Everybody's talking about, I need staff, where do I find staff? If you look at the ads for work, it's a fantastic time to look for work. So people are thinking, how do we remunerate, for example, employees, executives, and maybe it's not just cash, maybe it's share-based payments. And therefore, there's also potentially as a result of COVID, they want to change the measures. So people do feel that their share-based payments do give them some value, because why would I stay if I've got a share-based payment that's so out of the money? And all of these kind of, again, the word is modifications. All these modifications of existing share-based payments or cancellations of old ones, reissue of new ones, you know, is that actually one thing? You know, it's really throwing up a lot of questions. Share-based payments, IFRS 2 is a beast of a standard. And it's a beast of a standard for new share-based payments. It is an absolute horror show when we start to cancel, modify share-based payments. And therefore, I just wanted to put it on your radar on changes that we're seeing around service condition, non-market performance conditions, market performance conditions, you know, replacement awards, etc. So this is just if this is your reality, please reach out. It's a horror show. Kevin, maybe a few comments on refinancing. And again, the word modification is a key word. I know that many clients are modifying convertible notes, modifying bank loans, etc. And again, IFRS 9 in this specific area is really complex. But I'll hand to you.
Thanks, Aletta. Yes, and you are right. And this one we snuck in because as we approach 30 June and going concern becomes an issue, and a lot of organizations start to, you know, figure out that some of the benchmarks that might come with their financing aren't being met, there is a lot of renegotiation going on. The other thing is the IPOs. There is still a lot of IPOs in the system. People look into IPO, trying to get that done before certain dates. I've noticed that September, October now is the new date for the next batch of people to try and be IPO'd. The convertible notes are starting to come into it. And you are right on the refinancing, it's starting to happen. Now, the first part we'll do, or the first slide we'll do, is renegotiating with the bank. This was probably foreseen in a way by the international standard setter, but there are very specific rules in the accounting standard now, IFRS 9, on how to account for a really financial loan or financial liability that is a modification. Now, we call it modification, you're going to call it a renegotiation, but it's essentially an agreement between parties where you've got a liability on your balance sheet. And let's take short-term creditors out of the mix. Let's talk the long-term stuff here, where essentially you're not going to meet the previously agreed repayments, you're going to change the terms. Now, whether that's change the interest rate, change the timing, they're all essentially an agreement or renegotiation of terms. There's a very specific way to look at that in the accounting standards. Now, the slides we've put up on here is you've got to look at the present value of the revised cash flow and then compare that to the previous amortized cost on your balance sheet. Now, I'm not going to get into the detail, but there really is the concept you've got to look at is this a substantial modification or is it a non-substantial modification? What the difference between those two is, and Aletta's got the timing nailed in the slide changing, so thanks Aletta, is really, do you de-recognize the old liability and start again with a new liability, or do you keep going with the old liability at the original effective interest rate? Because clearly the answers are going to be very different. And clearly what happens is there's either a profit and loss adjustment either at the time, or the profit and loss adjustment essentially amortizes into the future, depending on, are you de-recognizing the old and re-recognizing a new, or are you just keeping going with the existing financial liability on your balance sheet, and it's really just a change of terms, and you haven't got a de-recognition of the old one. This concept may be, I actually think, Aletta, I'm going to kind of say to you, this is a lurker problem. We talk about all the other ones, but this one hasn't really hit yet. And I got my first big question the other day from our business services team who ran into one of these, because not only is the question, is it a substantial modification and therefore I de-recognize the old liability and put the new one on the balance sheet, but you actually have to take the transaction costs into the calculation to determine whether it's a substantial or non-substantial adjustment. And the transaction costs can be enormous on some of the 10, 15, 20-year loans. So the transaction cost and the price of the costs you're paying to renegotiate themselves can be determinative in whether you've got a substantial modification or a non-substantial modification. So don't let this catch you you know, at the end of the day, we haven't considered this, because it has a profit and loss impact. The timing of that profit and loss adjustment is important, and like I said, costs and fees come into it. I'm going to jump past this one because no, sorry, this is connected. Sorry, Aletta. Extinguishment of financial liabilities. Lots of organizations, as part of the renegotiation of their liabilities, are actually just giving shares. They can't afford the cash flows in terms of what was previously agreed, and they're extinguishing the liabilities by issuing shares. A decision tree, I love this decision tree. It's nice, it's pretty, it's in BDO colors. There is a scientific way to get to the answer at the bottom, but the idea behind this is it's not a straight transfer from financial liability to equity when you've replaced a liability with an issue of equity. There may be a profit and loss adjustment on that, and you do need to follow this decision tree. It's IFRIC 19, which is an interpretation. The interpretation is pretty clear, and the interpretation does interact very nicely with the previous rules about modifications of liabilities. But here's the kicker: the interpretation doesn't actually apply to parent subsidiary type arrangements. And the thing is, most extinguishments of financial liabilities are with parent organizations, where the parent organization just converts the liability to equity. So what happens is there's this kind of a hole in the accounting standards where, especially in group scenarios, the liabilities are being replaced with equity instruments. There's no standard that really covers that, so you kind of have to develop an accounting policy around it. And a couple of months ago, we did accounting policy choices as one of our webinars. So it's an area that you can also get caught really quickly. And then finally, on convertible notes, I think we may have done more convertible notes than anything else on these webinars. We've got a wonderful guide that was issued a couple of weeks back, or maybe a month or so back, issued by the BDO Global team. And it has this wonderful decision tree or flow chart in it that will take you through how to account for convertible notes. Now, the big thing with convertible notes is when you first issue them, is it equity or liability or both? That's the first one, that conceptually at a high level. Now, look at that. That decision tree may, I mean, I can't believe Aletta got it onto one slide, so well done, Aletta. But the big question with it is, do you have a liability, do you have equity, or do you have both? The thing with a liability, it's not always a liability that it's a loan. Sometimes it's a derivative liability, which means there's fair value accounting and profit and loss problems lurking in there. The thing is, each of these questions look like just plain sailing questions, but they aren't. Getting into each of these questions by itself could be an IFRS advisory engagement. And we often, especially the first 4 questions in the decision tree down the left-hand side, are the ones that we often spend weeks consulting with clients over. That's first of all determined, and then throw in a modification when the convertible note's not going your way, and then you've got to head back to the first one I did with, which is present value of cash flows, modified cash flows. Do you have an extinguishment and a substantial and a non-substantial? And it can get pretty complicated pretty quickly. So I think that my lesson on this one is, if you're in the financing part of your world, where you're either issuing convertible notes, renegotiating convertible notes, renegotiating your existing liabilities, possibly even renegotiating it by way of replacing a liability with equity, any of those, if you're in that space or have done any of those in the last financial year, think about it really quickly. What is the accounting around it? Because it's not as simple as you think, and there's often a valuation required, and there's often a profit and loss adjustment, which can hurt earnings as well. And that, of course, will then also feed into going concern, because very often your decisions around financing are actually all driven by your ability to stay afloat. So there'll be a going concern connection there as well. With that, I'll hand over, I think it's to government grants. Aletta, are you going to just run through that one quickly? I think you're on mute, Aletta.
I was bound to do that. Thank you, Kevin. Apologies for that. On government grants, we've been talking about this old standard a lot over the last year. The latest twist to this is the relationship between R&D incentives and how we account for those and government grant standard. So in our accounting news at the end of last year, we talked about R&D incentives that are refundable, that are treated as government grants, and what the appropriate, or what are treated as government grants, and what the appropriate disclosures and treatment would be. And we also had an article on non-refundable government R&D incentives, and there's 3 different options, policy choices. So I think I just wanted to flag that government grants, it's not over. We're still seeing a lot of activity. We still see a lot of government stimulus coming through the budget. And I think the one to really look out for is that R&D incentive and the link with government grants. There's also a link between the instant asset write-off and R&D incentives. and government grants, believe it or not. And I think the key thing there is if you've got an R&D incentive that's linked to an instant asset write-off, and that that R&D incentive is treated for as a government grant, the fact that the asset has been instantly written off for tax purposes, it doesn't mean it's already been written off and fully depreciated for accounting purposes. Therefore, even though you had an instant asset write-off for tax purposes, the asset is on your balance sheet, you're potentially depreciating it over 5 years, and therefore the related government grant should also be recognized in income over 5 years. So I think a lot of people are just saying R&D incentive, government grant, book it in income immediately, especially when it's linked to an asset that's already been fully deducted for tax purposes. And that's not right. So that's something to be on the lookout for. So I want to put that on the radar. And then obviously you've got different presentation options around government grants. So I think just put it on the radar. Kevin, around the latest developments, I would say these latest developments is a bit of a combination of an update on a court case in Australia around remuneration. It is a recent IFRIC agenda decision. It's not an actual interpretation, but just an agenda decision that is creating havoc across the world, but it's particularly bad in Australia because that agenda decision came out in April and our reporting date is 30 June. So we've got 2 months to get our heads across it. So I just wanted to flag that. So maybe I should...
Yeah, sorry
Kevin.
No,
I'll
I thought you were handing out.
No, so I'll start with the remuneration underpayments. As you know, in the media over the last few years, there's been a lot of bad publicity around underpayment of wages. It's a real issue in the Australian economy. And, you know, several large businesses have admitted, and it's often inadvertently, for underpaying staff. And we know all these awards are very difficult. You need systems to manage it, and there's a lot of risk involved. Now, the AASB last year already issued some FAQs on how do you account for those underpayments. And I just wanted to put that back on the agenda because this is still an issue. We're still seeing these reports coming out, and I know our tax partners, Ben Renshaw in our employee tax area is doing a lot of work in this area. So please make sure that you've got that sorted. If you need help of an expert, that they can have a look. The other thing that's a real big deal, and it was a big deal last year, 30 June 2020, was around employment entitlements of casual employees. And there was the Rosato court case last year before 30 June. There's all kinds of decisions whether what will happen on appeal, will they appeal, what will happen. There's new legislation to address the situation, and there's talk about this new legislation being retrospective. Sorry, some entities who might have recognized provisions for underpayment of these casual employees might now, if they've got legal advice in place, based on the court decision, the new legislation might be able to reverse those positions. So again, I want to put it on the table. I'm not saying what the answer is. This is really depending on your facts and circumstances, arrangements with your employees. And I would like to say that you need to get legal advice around casual employees. And in our June accounting newsletter, we'll have a detailed article on all the things to consider. But I wanted to put it here because it's a big thing. So underpayment of employees, you know, potential entitlements of casual employees, remuneration is still hot. And as you imagine, you know, it's a sensitive matter. Kevin, I'll hand to you to talk about the other big one, which is around SaaS customization configuration costs. And this has been this agenda decision by the interpretations body in April. And, you know, we have to address this by 30 June. So Kevin, over to you.
Thanks, Aletta. And I mean, just for a bit of context on this one, it's moving so rapidly in terms of its practical implementation, that yesterday Aletta and I did a accounting conference, chartered accountants accounting conference session for not-for-profits, and this features in that area as well. And since then, we've actually spoken about it since, and we've realized there's some more teeth attached to this. So it's going to be one of those conversations where I say, if you are in this bucket, think very carefully about what's going on here and keep your eye peeled for some further information coming both from the standard setters, but BDO will probably also address this at some point in future communications. Because what's actually going on here, it's actually been bubbling along for some time. And so you'll see there was a March 2019 decision, and then there was an April 2021, and now it's at June 2021. And so it's actually been bubbling along, but it actually doesn't technically change anything, except it changes everything, because what this is an interpretation that, as far as the international standard setter is concerned, was always obvious. But the problem is in Australia, and probably also around the world in some areas, but particularly in Australia, it turns out we've all been doing it another way. And so like all things in Australia where you start from a different starting point, we're clearly in many quarters not on the same page as the standard setter. So now we have to move. And clearly it's already in play, which means you've got to consider this at 30 June. Now, I'm going to walk past this slide because there's a lot going on this slide. And actually, Aletta, I like this one. Thank you for putting it up. Really, the triggers you want to look for purposes of your 30 June 2020 is, are you doing software development, one, or are you actually just also doing a software as a service implementation where you're essentially moving on to, let's say, a SaaS supplier's online cloud service provisions or something along those lines, where you're essentially buying somebody else's software or looking at online software, or the software's in the cloud on a SaaS platform, anything like that, where you're essentially ultimately going into the new age. And what happened in Australia, perfect storm. It wasn't only that this issue's been bubbling along at the international standard level, but what's also happened is, because of COVID, a lot of organizations took the opportunity to move online and to move onto SaaS platforms, software as a service platforms, because of COVID. People working at home, so their previous IT wasn't really keeping up. And so during the pandemic, this was all happening. Those of you on Teams there, Microsoft Dynamics 365, it's all SaaS online service provisions. So any of those sort of engagements, which then led to some organizations capitalizing software, or at least capitalizing their configuration or customization costs. Those are the target costs here. And it's the ones that are capitalized as an intangible asset that are the problem ones. Because the question really at a very high level is, do you actually have an intangible asset you control? Or are you capitalizing costs that actually relate to a software that's not yours? It's actually the SaaS software, it's owned by someone else and controlled by them. And for those of you who are moving on to SaaS, you'll know that software development costs are very different to the good old days where, and that's on the right side of the diagram, where you actually had an internal project to develop software and then create it. With SaaS, what's actually happening is you're essentially just subscribing onto an online platform, paying your annual subscription fee, and if you cancel it or you end your period, then you no longer have access. So the question is, what's the asset you have access to, and what's the asset that you control? If you just cancel it, it just goes away, because they just shut down your subscription to the platform. So the question is, what's the intangible asset? Have you incurred configuration customization costs, and have you capitalized those, or are you planning to? And here's the kicker: if you've done this in the past, do you have a prior period, and I don't want to use the word error or restatement, or is there a material adjustment coming? Because as I mentioned at the beginning, the international standard setter doesn't think anything's changed here. They just clarified what they thought was obviously the answer. So you might have actually done this in a prior year, let's say the comparative year, and maybe you got it wrong, and it maybe the numbers material. So maybe that's the fear factor introduction. I think that covers it high enough for you to say, by now you should know if you have a problem. These words I've used are, you'll know if you've got it: intangible assets, customization, SaaS, customization and configuration, online platform, software as a service, any of those things in the last couple of years, you probably want to look at that, and did you get it right? I think that really is a letter at a high level, all that I probably need to say at this point on
yeah,
that.
and Kevin, I think a way to look at it is, if you look at your balance sheet, do you have capitalized intangible assets that relate to software, customization, integration, etc.? If you've got it, let's have a look at what supporting documents do you have in place, and do those relate to an actual intangible asset and software that you control on premise, or does that relate to integration, customization of software that you access through the cloud? So start with the balance sheet, then think what does it relate to, and then think, do we have a problem? Kevin, I don't think we'll be restating comparative years, because I think this is a clarification of divergence in practice. So that's where I would be going, and that would be my argument. However, the other thing I want to put on the table is something that you're reading about a lot, and that is ESG, environmental, social governance, or sustainability reporting. In our newsletter for May that will be issued tomorrow, I've written an article on environmental factors, what are included in the E. I've put in an article on what is included in the S, and it's very far-reaching, and governance. So the E and the S and the G is very far-reaching. And the question that investors are asking our clients are, what are you doing around ESG? You know, what disclosures do you have around ESG? Now, some people already have a separate sustainability report addressing this, but is that in any way linked to what you put in your financial statements? All right, so that's another question. The other thing that I think I want to put out there is, if you wanted to speak to us around maturity assessment, what your peers are doing, what our recommendations at the moment are, please reach out to me. So ESG is one of my new favorites. So there's an article. In particular, I believe one should start with a maturity assessment, as in, what is our assessment as an organization around ESG maturity? What is the, where do we want to get to? And then develop a roadmap to get there. From a reporting perspective, the IFRS Foundation is looking at establishing a sustainability standards board to sit next to the International Accounting Standards Board within the same home, so that the two standard bodies are actually encouraged to work together, but because we're looking for that connection between sustainability reporting and financial statements. So I've put in two documents that relate to the latest developments. They are starting with a focus on climate, which is one of the things in the E for environment. It looks like that's where most focus is at the moment, and Ashley would tell you that in natural resources, in mining, absolutely there's a big focus on this. So again, please reach out, and there's that article in our accounting news. We've previously talked about payment times reporting scheme. A lot of clients have actually reached out and said, Aletta, come and speak to us. How can you help us? What systems do we need? So Tom, that presented at the start, Tom and I are speaking to some clients at the moment around, do they have to report? And if they have to report, what do they have to report? When do they have to report? How do we gather that data? So I think that's really important. So please contact me if you need any help around payment times reporting scheme, and again, working with Tom. To wrap it up, this was a marathon session. Well done if you've lasted till the end. If you're watching the recording and you've watched it in little bits, well done, you got to the end. To Kevin and Ashley, thank you very much for presenting with me. Obviously, if you need to discuss anything, any of these IFRS matters, please reach out to our leaders across the country. You can obviously speak to any of our team as well. You can speak to your local BDO contact, which will direct you to us. I just want to say thank you very much for joining. Next month, we're going to talk about impairment. And it will be a fantastic session before getting ready for 30 June reporting. Look out for our accounting news this month. I've just recorded the overview video this morning. There are 12 articles in there across 8 different sections. So there's a lot happening before 30 June 2021. I hope you have a lovely day, and we'll speak next month. Thank you very much.
Fine. Thank you, Aletta. Have a good day. Bye, Ashley.